Hi, welcome to another episode of the Financial Freedom Podcast. I'm Steve Richardson, a bankruptcy attorney trying to keep people on their path to financial stability and independence through education. The ultimate goal of retirement savings is to have a source of income once you leave the workforce for good. One of the scariest things about retirement is that leap of faith that you will still have the money to pay the bills once there's no longer a paycheck. One way to address this is to plan for streams of income in advance, like annuities, which I discussed in episode 218. But it's good to have options, which is why in this episode of the podcast, I talk with Tom Wall about how life insurance can create another stream of income. Hi, my guest today is Tom Wall, who has spent his entire career positioning whole life insurance and competing against its alternatives. Starting in college as an award-winning advisor with Northwestern Mutual before moving his practice to Mass Mutual, he subsequently grew his career in prominent home office roles in sales and marketing leadership. He's a well-known storyteller at perennial company conferences and firm meetings nationwide, while most recently rejoining the field to drive organizational growth and inspire a cultural shift. His belief is that whole life insurance is the best kept secret in financial planning. Throughout his career, Tom has always focused on academics and selling from a place of integrity. Most recently, he has completed original research and a PhD dissertation on whole life as a fixed income alternative. Welcome to the show, Tom.
Thanks for having me, Steve. Appreciate it.
Yeah, well, I got to tell you, I've had a lot of folks on the show. We've talked about different aspects of financial planning or financial freedom, personal finance and retirement investing and everything. And they know a lot, but I don't think I've ever had anyone on the show who actually wrote a doctoral dissertation on the topic we're going to talk about. So I got to tell you that's news that's different. So I got to ask you, how did you get into this? Well, where did that interest and passion come from that you decided to make that the topic of your PhD?
Well, thanks for asking. It's an interesting journey. I started in the financial services business right out of college, 22 years ago, basically selling life insurance,
Mhm.
with the goal of becoming a full-fledged financial planner, which I eventually did with all the investment licenses and all that comes with it. Subsequent to that, I actually was a home office leader for one of the major mutual companies that sells these products, and all throughout my career, I was just bugged by this wonder of, am I basically talking about a product that is a good offering that you're probably not going to have to apologize for long term, or is this actually the best thing people can be doing with their money? And that kind of bugged me the entire time. So it led me to years of studies and multiple degrees, and eventually a PhD in retirement income planning, but focused around whether or not this stuff made sense. And I can tell you, in that process, I got to the point where I realized that not only is this a good idea, I actually think this is one of the best kept secrets in personal finance, for a lot of different reasons. One of which, it's called life insurance. I mean, there's nothing unsexier than that. But when you actually understand the economics of some of these tools that you can use, it's pretty mind blowing. The certainty and the guarantees that you can place in someone's financial plan, while not having to sacrifice anything, which I think is always what people think. They think there's a trade-off of sorts. And that's the magic. That's the efficiency we're looking for.
Okay, well, this is certainly something different, and I know when I first heard about you, I had never thought about whole life insurance as a source of an income stream. And I know
Yeah.
that you can get like annuities, which are essentially an insurance product, but not something like with a life insurance policy and being able to use that for income. So there are obviously a lot of parts with a retirement investment strategy, whether they're IRAs, 401ks, or annuities, as I mentioned. How does the whole life insurance play into that mix, at least from an income standpoint, as opposed to investment and growth?
It's a good question. So I think you got to think about it a little bit differently. So what I have found is 99% of the literature out there, the radio shows, the magazine articles are all about accumulating wealth. How do you save tax efficiently? How do you get to your number? However many millions that is for you. How do
Mhm.
you get to that number where you feel comfortable retiring on? And that's kind of where the conversation stops. But that's just the beginning. There's really two phases. The analogy I've heard is kind of the move up the mountain, and when you get to the peak of the mountain, that's when you have your number, and then you flip the switch, and now you're retired. But no one talks about how you get down the mountain. How do you effectively spend down all those assets? And the reason that's such an issue that I got fascinated with early in my career is, imagine you show up at retirement and you did a good job. You've got your millions of dollars or whatever your number is. Now you're never going to earn money ever again. That has to last as long as you do, which is, on average going to be 15 to 25 years, but there are people living 40, 50 years into retirement, and that could be you. So how do you spend? Knowing that you're never going to earn a dollar again, how do you spend? And that's the issue is we have seen this in study after study. Millions of Americans right now are under enjoying their retirements because they're living scared. They're hoarding their wealth just in case really bad things happen, which probably won't, or just in case they live a very long time, which they probably won't, but they could. And if they run out of money, it's catastrophic. I can run out of money today and go bankrupt, but I'm going to be able to build myself back. That's not the case when you're 70 something years old. It's just not the case. So that's the issue. That's the issue with retirement income planning. How do we allow people to spend and enjoy that which they've spent a lifetime accumulating in the earliest, healthiest years of their retirement versus hoarding wealth and then maybe giving themselves a pay raise when they're 80 or 90 years old? Like that's just, in my opinion, that's malpractice if that's what your advisor is coaching you to do.
Mhm.
Um, and that's really where the discussion comes in about insurance-based strategies, annuities, life insurance. None of these are fun to talk about, but what they do is they shift those risks away from you so that with the rest of your money, you can actually spend and enjoy it and not even really worry about spending it down because you've got those guarantees in place.
Mhm. Yeah, it's a scary thing. I mean, you like you said, you're never going to have a paycheck again. You're never going to have that income. If you're fortunate enough to have an employer that had a pension plan, usually with government or union workers or things like that will have them, where okay, every month I'm going to get a pension payment of this amount, and then Social Security comes in to some extent as an income stream. But other than that, you have all these assets that hopefully you've amassed and grown over your working life. But how do you, as you say, flip that switch from thinking of it as an asset to thinking of it as an income stream? Now you might rebalance your portfolio into from growth stocks into income stocks that can produce a nice dividend stream. But again, how do you do that? How do you think about that money in your retirement portfolio as an income stream? How much do you take out? Do you sip it? Do you chug it? But how do you find that happy medium so that that income will last as long as you do?
Yeah. And there's no guarantees. I think the issue is there's a couple different ways you can handle it, just traditionally. One is you can turn your savings into a pension. So you can turn your savings into a guaranteed income stream that you can't outlive. It's called an annuity. So in its simplest form, you essentially trade your dollars in for a guaranteed income stream that you can't outlive. And the payouts on that are fantastic today. It's a really good deal, actually.
Mm-hmm.
I think on $1 million, for a 65-year-old male, that most recent numbers I saw, you could get $75,000 off of that or 7.5% up front forever, no matter how long you live. So, with any reasonable life expectancy, that's a really nice deal. Um, the trade-off for that, though, is you're trading in your money. So that doesn't feel good for people. You lose liquidity or access to that capital. And the other piece is if you live a while, which almost all people will if they're making that bet, there's nothing left. There's nothing left for the next generation. Once you die, that income stream is gone. Just like a pension, when you die, there may be spousal benefits, but generally speaking, there's nothing left for the next generation.
Mm-hmm.
Alternatively, there's the investment world. So the investment world is, you're going to have your stocks and bonds and various asset classes, and you're going to manage it appropriately and live off of it. But at the end of the day, you're just betting on probabilities. most of the simulations that we see in the financial planning world are based on, means and standard deviations and data from the last 100 years to try to project what probabilities are moving forward. And that makes a very big assumption that the next 100 years looks like the last 100 years. And the last 100 years in the United States was the biggest economic expansion the probably globe has ever seen.
Hmm.
In fact, there's no other developed country in the planet that looks anything like the development that the United States has seen.
Hmm.
So I think it's foolhardy to think that we're just going to manage a portfolio based on past probabilities and we're going to be okay. Knowing that even if there's only a 1% chance that we run out of money, that's a catastrophic 1%. If I had a 1% chance of my plane crashing, I'm not getting on it. It's that kind of thing. So that's really where I come from. It's obviously very, very philosophical, but I know for my retirement, I want my worst case scenario to be not completely broken poor. Like, I want to make sure that I've got that safety net built in so that my loved ones are taken care of. I've got liquid sources of capital that are not tied to stock market,
Hmm.
which could be crashing the time I need it. And also, protect against some of the other things that can go wrong.
Hmm. And certainly, I mean, an annuity is, a good choice if you don't have a pension, if your employer didn't have a pension. But it
Yeah,
doesn't always, again, I guess, depending upon the annuity you get, whether that's necessarily going to track with inflation, whether that's going to be your income stream, how much you make. But as inflation goes up, is that payment going to be able to cover things 10 years down the road? So it's
right.
always good to have something else that is a part of your portfolio that continues to grow, maybe in a Roth where you're not forced to take it out through a required minimum distribution and you can let it ride as a hedge against inflation. So we've talked about an annuity as one way of getting that switching from growth and savings to generating income, along with maybe rebalancing the portfolio to income stocks. But how does getting to the big question of our episode and our talk today, how does life and whole life insurance come into the mix as far as how you can create a stable income stream?
It's a good question. There's a lot of different flavors of whole life insurance, but the one I talk about is dividend paying, participating whole life insurance issued by a major mutual life insurance carrier. And that word mutual is really important. Mutual companies are effectively owned by their policy owners. So when you own a policy, you don't necessarily own a piece of the company like you do with a stock.
Mm-hmm.
But the company operates for your benefit. There are no shareholders taking quarterly profitability. So when the company makes money, they distribute it via what's called dividends. It's essentially, a give back of anything they overcharged you, and it's a give back of outperformance above and beyond the guarantees. So a good example is, if you buy $1 million policy, I own a $1 million policy, for instance. When I get to retirement, I know that my kids, at the very least, are going to receive $1 million when I die, no matter what happens with my investments or anything else. These policies also build a cash value so that I know by age 100, my cash value, my accessible dollars, will be worth no less than $1 million on a guaranteed basis.
Mm-hmm.
Now, on the non-guaranteed basis, including dividends, all these major mutuals, the ones that I would buy from at least, have existed since the mid 1800s. They've been paying dividends consecutively every single year since Civil War times. So for me, it's not really a question of if they're going to pay a dividend. It's really the rate at which they're going to do it. And as those non-guaranteed dividends compound, very much like compound interest in another account, it becomes a bigger and bigger piece of the puzzle where that million may grow to 5 million by the time I'm age 100. And those dollars are safe and stable. Once I get credited those dividends, those are now my new guarantee. That can't be taken away from me. So it creates this stability in my portfolio and it creates the backstop. So to give you an idea of the strategy, if I have a bunch of money saved, whatever that dollar amount is, but I know that my spouse and my kids at the very least are taken care of. If I have charitable interests, I can guarantee that upon my death, those charitable interests are taken care of. And I know that there's a stable source of cash that I can touch at any time without 59 and a half rules or no RMDs or any of those typical strings that are attached,
Mm-hmm.
really unlimited tax advantages, then that gives me the confidence to A, stay more fully invested in the market, whereas most of my peers are going to be, basically moving out of the market close to retirement,
Mhm.
but also spend more aggressively. You know, a lot of folks, if you've been running the show, I imagine you've talked a little bit about the 4% rule, which some people know
Yes.
about for retirement income planning. The 4% rule is pathetic. It actually was never meant to be a rule. It was, you know, the financial advisor who founded that accidentally stumbled upon it when he was trying to figure out what was the worst case scenario over the last 100 years in the market. And basically, what was the worst initial starting withdrawal rate that you could have taken and still had money last for 30 years in all of the various market cycles? And 4% was the low point. But most folks could historically could have taken 6, 7, 8% in many of the scenarios, much like almost double the income and been totally fine at the end of that 30-year period of time. But since you don't know which person you are on the day you retire, you kind of have no choice if you don't have these backstops put in place. You kind of have no choice if you're a prudent person than to live to that worst case scenario. And
Mhm.
like I said before, that may not be the worst case for the next 100 years. Like the worst case may be in front of us. So that uncertainty, at a time when you are not going to earn more income, it's terrifying. So that's effectively the strategy. Now, now life insurance is often used as a place that you can get income off of. So the tax advantages is really the key with these permanent life insurance policies. The Congress has granted them amazing tax treatment because it serves a social good. It basically provides benefits for the next generation and
Mhm.
doesn't have them living off the government. Um, so that's why they're there. But these policies allow your money to grow tax deferred. So as there are gains in the contract, you don't pay taxes. Another sneaky one that people never think about is FIFO accounting, first in, first out, meaning you actually get your cost basis or what you've contributed back first before you have to recognize any gains if you were to cash out. Most other vehicles, almost all other vehicles, you're going to pay taxes on gains first before you get your contributions back. And then there's also this provision called policy loans, which sounds bad to people that haven't seen it before because you're borrowing against yourself, if you will. You're borrowing against your policy. But loans are not treated as a taxable event. So policy loans allow you to get above and beyond your contribution to the plan, income tax free back. So it's more complex than we can cover in a podcast, but there are ways to get back multiples of what you've paid in over the course of your life in retirement income, 100% tax free, and then still leave a legacy to the next generation. So for a lot of folks, you know, I haven't seen a lot of people use it as a systematic distribution, but we have seen it strategically used where, you know, once out of every 4 years when the market crashes, use it as a place or as a source of capital while we let our investments recover.
Mhm.
Or I've seen it used as a tax mitigation strategy. Like if you're living off of a number and if you take a little bit more income, it pushes you into the next tax bracket. It can actually allow you to manage your tax bracket down by taking a portion of your income from this tax-free source.
Mhm.
So my book is called Permission to Spend, and the crux of the book is not necessarily using life insurance as a tool that you're just going to spend down to zero. It's really more as a tool that serves as a backstop and guarantees that your legacy is paid for, that you have that liquid source of capital, that you have potentially a rider on there that allows you to use additional funds to pay for long-term care. And when you shift a lot of those big risks in retirement, it can make people feel a lot more comfortable, feel like they have permission to spend their assets, or like we talked about before, permission to annuitize their assets,
Mhm.
trading liquidity, trading legacy for a higher income, because we know we have that with that contract.
Mhm.
Um, that's effectively the whole strategy.
Well, it sounds to me that, as you say, people are afraid. They have a hoarder mentality. They have this money that they've saved during their working life, and then they're afraid to spend it, and therefore don't benefit from it. And it seems to me that a good part of the message of your book is to say that's okay. If you follow these procedures, you can take that money out and you'll be all right. Sort of overcome that fear. And for the listeners out there that might be worried about that, say, hey, yeah, once I have all that money, how do I spend it? And how do I make sure I don't spend it in such a way as I run out too soon? This book can be a big help to them, right?
I think so. Yeah. And inherent in all these conversations, when people say whole life is bad, or I don't believe in whole life, or um, those kind of things, and whether they say it or not, they're inherently saying, well, if I move money to this life insurance strategy, it's costing me elsewhere. I could have done better elsewhere.
Hmm.
And that's actually what my research proved, is that's not true. So these contracts, the performance is based on the general investment account of these major mutuals, basically giant bond funds and income, almost like an income fund that you might invest in yourself,
Hmm.
is backing up these portfolios. And that's why all these companies have AAA ratings and are so highly rated, is because they're sitting on war chests of hundreds of billions in dollars in capital, backing up these liabilities, the debt benefits they put on the books. Um, so the point of that is there's no trade-off. These contracts tend to have very bond-like performance over time.
Hmm.
So when you think about a retiree's portfolio, they're going to have stocks, they're going to have bonds, they're going to have cash. And all this does is it replaces a piece of that bonds and cash and what I just broadly call the safe stuff.
Hmm.
And you get similar returns that you would otherwise. But now you've got guarantees and a whole bunch of insurance benefits, from the insurance company that you just can't replicate on your own.
Hmm. Well, I think to some extent, people in understanding insurance, they say, well, you've got the death benefit. You say you got $1 million policy. If you die, your beneficiary or beneficiaries get $1 million. But there's also another component to it. What you're describing are these dividends and these earnings that you're getting from these mutual insurance companies. So
Mhm.
aside from the death benefit, the stream of income is actually coming from these dividends. Is that what is
Yeah.
that? That's how it's working, just so people understand where the income is coming from, as opposed to the death benefit.
Yeah, so it's the dividends, the accumulated dividends, and you can actually access the guaranteed values too. So you said a key word there in that statement. You said if. The thought process is when something is called insurance, then you get paid if something happens, right?
Hmm.
That's effectively the nature of insurance. So people don't like to put a lot of dollars into insurance contracts, or even insurance on your cell phone is kind of a bad deal if you actually do the math, right? People don't like to pay for insurance because they're probably never going to use it. But for big catastrophic things like your home or your car, you have to, or health insurance, like these are going to wipe you out. That's what insurance is for, is to protect against catastrophic loss. The interesting thing about permanent life insurance, particularly guaranteed whole life insurance, which is permanent, is it's no longer if. Like we all will die someday, that is a certainty. And these contracts will pay out when you die, not if you die. So I know there is a guaranteed delivery of future dollars to my family when I'm gone. There is immense value knowing that. If I know that my kids are going to get $1 million, that's $1 million I can spend during my lifetime and not worry about it. If I didn't have that in place, now I'm hoarding wealth to make sure that there's something left for my kids or my spouse who I'm obligated to leave money to, right? And
Hmm.
that's the mind shift. And again, I think the myth is if I do the insurance-based strategy, that's going to cost me in the market. But that's a bad comparison. It may cost you the equity exposure, right? It's not whole life is not going to perform like the S&P 500 has over time,
Right.
but it absolutely performed very much like the bond piece of your portfolio. So we have seen clients, and this is roughly how I manage my own money, where participating whole life insurance is effectively the cash and bond piece, and
Hmm.
all my other assets are extremely aggressive because I have that safety net in place.
Hmm.
And over time, I believe I will get more efficient outcomes than the average investor because of it.
Hmm. Well, it certainly removes the worry that you'll still have a legacy for those you leave behind in that face
Yeah.
value, in that death benefit. But I guess I just want to make sure I understand and the listeners understand where that retirement stream of income comes from. Is that the dividends that are being paid out by the insurance company?
It can be. So you can take dividends off of these policies. Absolutely. There's different ways to fund them. So you can fund them with a low premium for forever, essentially, which is typically going to give you the highest death benefit.
Hmm.
There are thresholds that the IRS has set. The tax deal is so good they limit how much you can put in, but they're very high. So
Hmm.
you can dump a lot of money into them in a very short period of time, and those are typically designed to draw income from. So that it comes in the form of you can take dividends in cash. They call it a surrender, but basically withdraw what you've paid in. You can take policy loans, like I mentioned before. So, once you get back your contributions, you can continue to take dollars that are income tax free.
Hmm.
So there's a lot of different ways you can do it. But what I'm describing actually is more because that's in place, now I can more aggressively spend my other dollars. Instead of living to the 4% rule, where if I have $1 million, I start on day one of retirement with $40,000 of income, maybe I can take 60,000 of income or 70,000 of income, knowing that even if I'm in that one of those worst case scenarios and I do run out of money 20 or 30 years down the road, there's now this backstop of hundreds of thousands of additional dollars that will step in and make sure that I'm okay. But more efficiently, to your point, I would actually suggest most people, because they have this backstop and because they have these insurance benefits, annuitize their assets. Turn their retirement accounts into a pension.
Hmm.
And like I said, the payout rates are enormous these days in those early years.
Hmm.
So maybe not never ever, there's no such thing as a magic wand or a one size fits all. I would never suggest everyone annuitize all of their assets, but
Right.
to the extent we have these guarantees in place, we can feel far more comfortable annuitizing, spending more aggressively early on, staying more invested in the market, all because the safety has been or that the we've shifted those risks to somebody else, the insurance company.
Right. And everybody's situation is different. You're talking about the ability, like I said, because you have that insurance policy backstop, you can spend your other assets and they'll last you to the rest of your life, knowing that you have a legacy to pass on. But there may be people like my wife and I, we don't have children, so we're not really looking to preserve anything or pass it on. Or maybe there are people who have children that are successful in their own right. You're not worried about passing anything on.
Mhm.
I see a bumper sticker every once in a while. We're spending our children's inheritance. And I always look at that and say, well, good for you. It's your money. So this is a good product for and a good strategy for people for whom leaving a legacy is important. Uh,
Absolutely.
but other than that, if they're not worried about legacy, they're just saying, I just want to make sure my money that I don't outlive my money. Is this also a good strategy for those folks as well?
I think so. Less so, for sure. Without the insurance benefit, less so. But like I said, there's not really a trade-off. If you can get into these early enough, and I would say, ideally before retirement, but certainly early retirement is a good time to start. Even in that scenario where you're not so focused on legacy. In a husband-wife situation, you are focused on legacy to some degree to each other.
Hmm.
So
Yeah.
even in that scenario, knowing that there's benefit left over for your spouse allows you to, out of your accounts, spend more aggressively or annuitize as an individual versus a couple. And because individual payout rates are much higher
Hmm.
than if you were to annuitize as a couple. So there's absolutely benefits across the board. And the deal has gotten so good. There was legislation passed a few years ago that allowed the companies to rework how they construct the policies just to keep it simple.
Hmm.
And today you can actually overfund them to a greater degree than we've been able to since 1986. So there are contracts out there where in a very short period of time, 5 to 10 years, you can get them fully funded. And today, we're looking at policies that are earning net of internal costs, 5.5%, with no market risk, completely tax free. And I think most people would jump at those kind of rates today. So I think it's a tool for really anybody. Um, and it doesn't have to be death benefit focused. It can definitely be cash value focused. And that's going to be an individualized concern, I think.
Okay. So if there are listeners out there who are intrigued by this and want to look into it further, you mentioned towards the beginning of our discussion that it's not necessarily any life insurance carrier that would have the product that would work here. You said something about a mutual insurance company. I mean, what should they be looking in an insurance carrier to make sure they're getting the right product here?
Also a great question. You have to trust your advisor. When I look at the industry, people think financial planners are financial planners, just like doctors are doctors, but we all know that's not the case. A medical professional, there's all different kinds of specialties and where they came from. There's Eastern medicine, there's Western medicine.
Right.
Same applies to in finance. So
Hmm.
there's investment advisors. There's great advisors out there that have just kind of grown up in the investment world and they believe in markets and that's all they kind of do is manage money. And
Hmm.
then there's on the other end of the spectrum, there's advisors who just grew up in the insurance world and they just kind of do insurance planning and that's all they do too.
Hmm.
They're probably not going to be your best investment source. But the companies I'm referring to are the Fortune 100 companies with mutual in their names. So you look like Northwestern Mutual, Mass Mutual, Guardian, New York Life. Like these are kind of household names in the insurance world.
Hmm.
And there's advisors that are affiliated with them. Those are typically, they're not exclusive to those folks, but those are typically the advisors who kind of understand these strategies, have at least at one point in their career been motivated to position these products. And those are the ones that typically know how to do it. There's dozens of companies out there that actually have good products, so it's not exclusive to that group.
Hmm.
But I would say exactly what you just said. I think is one of the biggest problems in our space right now is people don't know who to trust. They don't know the advisor's leanings, and
Hmm.
if that advisor actually has studied it from all angles, or where they were born, or what kind of leanings they have, or bias. But I think what I'd be looking for is if you're looking for the right company to do this kind of thing with is, um, a major mutual that's been around for at least 100 years. All the big ones have been. They're AAA rated, so that their ratings are usually published right on their website. So there's four major rating agencies, and they should have top tier ratings with all of those rating agencies. And the reason they're so highly rated is, like I said, they're sitting on war chests of hundreds of billions of dollars. It's not like banks where they can loan out 9 times what they take in deposits
Hmm.
and hope that it comes back to them. These companies are reserving every single dollar, and that's they're basically unkillable.
Well, and next question just comes from our discussion before I hit record that, I've talked to a lot of financial planners for the show, and I know personally several of them, but and I never heard of this strategy before. Now, I think I know the answer. You talked about there being as many different kinds of financial planners as there are doctors. Is that why a lot of these financial planners don't talk about this particular strategy because that isn't their area, or are they shying away from it? Why don't we hear more about this?
Because it's not honestly because it's not fun to talk about. There's two major hurdles to get into this stuff. One, you have to be healthy enough to get it. So it is medically underwritten.
Hmm.
So you don't have to be a marathon runner, but you generally have to be of average health or better for it to look really good and perform
Hmm.
really well over time. And frankly, there's a lot of advisors out there that just don't want to deal with the medical underwriting and the potential to have to deliver bad news to their clients.
Right.
Whether or not it's the right thing to do, they just don't want to get involved in that. Sometimes they'll refer it away to other insurance experts.
Hmm.
A lot of them don't know. If you grow up in an investment house, your job is to gather assets, do 401(k) rollovers, call people and tell them how you're going to invest their money and make them more money than they can do on their own. You're just not having that conversation. Like, in my opinion, those people are not even financial planners. Like, they may be good investment managers. That I'm not saying they're doing bad work, but they're not doing holistic financial planning.
Hmm.
So when I look at, financial advisor as a category, there may be a million of them across the country, but there's probably a 10 to 20% that are really doing true financial planning where they're talking about all aspects of one's life. It takes a lot of education, a lot of years in the business to fully understand the investment world, the insurance world, the tax, the legal, all the stuff that goes into it. It's why you see most experienced financial advisors have a number of letters after their name. That represents all of the education and degrees that have been required to get to their level of expertise.
Hmm. Well, which leads into the next question. I asked about how to look at or choose an insurance carrier for this type of investment, since a lot of financial planners don't know about these products and therefore wouldn't be able to advise people on them as part of an overall financial plan. What letters should they look for after the person's name to be sure that that financial planner that they're shopping for can include this strategy in their overall plan?
Yeah, it's another great question. Some of my favorite best advisors, some of the smartest people that I know, don't have a single letter after their name. They just been in the business and studied it. So that's the hard part. I think CFP is the gold standard in our space, certified financial planner. It's a pretty rigorous schedule of exams they have to go through. That's
Hmm.
a very well reputation. There's one called CLU, which is Chartered Life Underwriter. That's less widely known, but that is somebody who understands life insurance and the strategies around it, and is typically going to be the kind of advisor who grew up in this space. I'd be looking for someone that has CLU after their name. I think if you see someone that has CFP and CLU together, that's probably someone that's going to know this strategy or work with people closely that do, and help you with that. Otherwise, CFP could be anybody, and it could be someone that is just focused on investments.
Hmm.
Um, that's how you make the differentiation.
Hmm. Okay, so we talked earlier the analogy to getting up to the mountain, climbing up the mountain during your working life, and you get at the top of the mountain and say, "Now what?" Uh, when folks are ready to retire and they're at the top of that mountain, what do you believe they should be most concerned about at that point?
What should they be most concerned about? I mean, the biggest risk to a retirement is sequence of returns. The and what sequence of returns is basically says, we know the market averages 10 or 12% over long periods of time, but if we have a major 2008 style crash, like the year after you retire,
Hmm.
and then you're selling those investments to live off of, it's only a matter of time before you go broke.
Hmm.
So the thing that they should be thinking about is, do I have assets that I can touch no matter what's happening in the market? If my $1 million account becomes my $600,000 account tomorrow because a nuclear bomb goes off in somewhere in the world, do I have assets that I can live on so that I can wait for my portfolio to recover versus being forced to sell low or just being so terrified of world events that I'm going to sell out of the market and lock in those losses forever.
Hmm.
Right? That's effectively what happened. That's what happened, by the way, in May of 2020. At the very bottom, people were just selling assets off during the pandemic because they were terrified of what was possibly going to happen. And
Hmm.
then it all recovered. It was a V-shaped recovery. Within a few months, it was all back. And a lot of people lost a lot of dollars because of the fear that caused. So if I'm retiring and I've done well, congratulations to me. I've saved my money. I've got my millions, whatever my number is. I want to make sure that I have buckets of money with different tax treatment so that no Congress in the future can change the rules on me and have me in a bad situation. I want to make sure that I have buckets of money with different risk profiles. One of those buckets being absolutely guaranteed to go up in value
Hmm.
so that no matter what happens to the rest of my buckets, I've got money that's rising that I can tap into. Uh, and, I think that covers it. If you can diversify taxes and you can diversify risk into various buckets of money with various different tax treatments and risk profiles, you're going to be very well served. And then to my strategy or what my book is about, a layer on top of that is if you can build guarantees for the next generation in, if
Hmm.
that is a concern of yours, which I think at least for husband and wife it's a concern, but certainly with folks with kids or charitable interest, if you can, that's kind of the next level thinking.
Hmm.
You're going to be fine in retirement, regardless of what the future holds or what the market brings to you.
Hmm. Well, it's one thing about annuities, and again, depending upon the annuity, but a lot of them will say, you buy this annuity and they'll guarantee a certain percentage rate of return, whatever that is, 4%, 5%, et cetera. So
Mhm.
if you look at that and say, okay, maybe that's one of the buckets, and say, I
Sure.
know if a nuclear bomb goes off, I'm still going to get that 4%, maybe more, but definitely that 4% uh, in income, right? So that's the type of bucket you're talking about.
Absolutely. That's exactly what it's for. So I think a phrase that I heard one time that we must insure against what can go wrong to have permission to invest in what can go right.
Mhm.
And I may sound like a doom and gloom guy here with all my guarantee talk, but I own I own Bitcoin, I own a business, I own real estate, I own all these things, I own stocks, I own all these things that historically have generated a lot of wealth. But
Mhm.
if all of your money is in risk assets at a time when the world is collapsing, which every generation has one of those collapses, what are you going to do? Right?
Mhm.
You need to have a bucket of money that is not exposed to that. And because I am so heavily allocated toward that safety, I
Mhm.
probably take more risk than the average person because I know I'm going to be okay no matter what. I can ride out those storms. Whereas most folks that have only risk assets, the sky starts falling someday, and they find out their risk tolerance isn't quite what they thought it was.
Yeah. Well, you've already given yourself permission to spend, and your book gives other folks permission to spend. So I'd encourage folk to look into that. I'll leave a link in the show notes to how to get Tom's book. It's at permissiontospend.com. And then you also
Yeah.
have a website, tomwalltalks.com. What can folks find on your website?
Well, I would say my website is permissiontospend.com for the listeners. Tom, I do a lot of paid speaking around the country, so Tom Wall Talks is really my speaking site.
Oh, okay.
But you can really check me out. My bio is there too. But the book's available on Amazon, and I would invite anyone to check it out there. And on permissiontospend.com, there's ways to get in contact with me. And
Mhm.
I know thousands of advisors around the country. I am happy to make an introduction to somebody who understands these philosophies and can serve you very well. So I invite people to do that too.
Well, that's the next question too. I mean, aside from your book, if people want to reach out to you for your help, how can they contact you and how can you help them besides your book?
Yeah, a great place to reach out is I'm Tom Wall Talks on Instagram. You'll see me flying around the country giving talks. LinkedIn's actually a great place these days. People ask me for my business card. I don't even carry them anymore. I'm just Tom Wall on LinkedIn. I'll pop right up. So yeah, if you want to get any help with this or get referred to what I feel is the right advisor, by all means reach out and I can make those introductions for you.
Excellent. All right, I'll leave those links in the show notes as well. And thanks for coming on the show, Tom. I know I've learned a lot from our talk, and I'm sure our listeners have about another piece of the puzzle in their investment strategy for retirement that'll give them permission to spend that money once they retire. So thanks for coming on the show, Tom.
Thanks for having me on.
Right?
Appreciate it.
Mhm.